Welcome to the Deep Dive. We're here to give you the analysis you need to really get behind the headlines. Today, we're taking a critical look at the Q2 FY26 results for HDFC Asset Management Company Ltd, HDFC AMC, obviously one of the giants in the Indian financial space. Now, our mission here isn't just to read out numbers from a spreadsheet. No. We're digging into those extensive financial filings to pull out two key things for you. First, the main quantitative results from the quarter ending September 30th, 2025. And second, maybe more importantly, the strategic qualitative moves management is signaling for future growth.
And that strategic view is absolutely critical, especially when you think about the market they were dealing with. HDFC AMC released these results when, frankly, market sentiment was pretty shaky. The Nifty 50 index, right, the main benchmark, it dropped 2.9% in July, then another 1.4% in August. But the bigger picture is this. In the full year leading up to September 2025, the index actually delivered negative returns overall. Now, normally, you'd expect investors to get nervous, maybe pull back a bit, right?
That's exactly the challenge. I mean, historically, a whole year of negative returns often triggers panic selling, redemptions. So what were the signs of resilience? Because the data from the broader mutual fund industry doesn't just show resilience. It suggests something, well, deeper is happening, maybe real behavioral maturity.
It really does look like a structural shift. Think about it. Despite that negative Nifty backdrop for the year, the industry saw colossal inflows into equity funds. Net new flows hit Rs. 1,490 billion in Q2 FY26.
1.49 trillion rupees.
Exactly. And what's really key is the acceleration. That figure is up massively, like 63% from the 911 billion they saw just the quarter before. So investors didn't just hold steady, they actually seemed to use the market weakness as a chance to buy more.
And that buy-the-dip mentality, it seems increasingly driven by systematic investing, doesn't it? That's the data point that always jumps out to me as signaling a real long-term shift.
Oh, absolutely. The core insight isn't just that the monthly SIP contribution hit a new record orders, 294 billion in September. That's big, yes. But the truly compelling number, the one that really points to that maturity you mentioned, the industry added 6 million new contributing SIP accounts in just that one quarter.
Wow. 6 million new systematic investors in 3 months. While the benchmark index was down year over year, it's astonishing. It really feels like the Indian retail investor might finally be moving away from just trading towards genuine long-term wealth creation, not jumping ship, but actually doubling down.
And management themselves were very keen to highlight this. They see it as proof that investors increasingly understand that short-term market swings are just noise. And SIPs are the tool to manage that noise. It's a fundamental change. It kind of insulates the industry to some extent from short-term panic.
Now, contrast that strength in equity with what happened on the fixed income side. The data there shows things cooled off quite a bit. Quarterly inflows into debt funds flowed right down to Rs. 148 billion. That's a huge drop from the Rs. 1,339 billion surge the quarter before? A massive difference. And specifically, if you look at liquid funds, which are often used more tactically, maybe by bigger institutions, they actually saw Rs. 219 billion in outflows. So that might suggest institutions were moving money around, maybe paying taxes, managing their own liquidity needs, not necessarily a sign of a broad crisis in sentiment.
Interesting distinction. And before we move off the macro view, there was that little nugget about niche assets, precious metals.
That's a good point. Gold and silver ETFs saw quite strong demand, actually. About Rs. 208 billion in inflows across the industry. And HDFC AMC certainly benefited. Their own gold ETF AUM jumped pretty nicely from about Rs. 102 billion up to Rs. 141 billion.
So people hedging their bets a bit. Another sign of maybe growing sophistication among investors?
Could be, yeah. Diversification in action.
Okay, so that's the industry backdrop. Pretty resilient, surprisingly strong retail participation. Let's pivot now to HDFC AMC specifically. How do they navigate this? How does a giant like them keep growing?
Well, starting with just the sheer scale, their closing assets under management, the AUM, hit Rs. 8.7 trillion for the quarter. That kept their market share steady at around 11.5%. And interestingly, management mentioned on their call that since the quarter ended, their AUM has actually already crossed the Rs. 9 trillion mark. So momentum seems to be continuing.
9 trillion rupees, that's just immense.
It is, but the really crucial part for their profitability is the actively managed equity part of that AUM. That stood at Rs. 5.4 trillion. And in that high margin space, their market share is even stronger at 12.9%. They really dominate the active equity category.
And that focus on equity definitely shows up in their overall asset mix, right? It's much higher than the industry average.
Absolutely. Their equity proportion rose to nearly 65% of their quarterly average AUM. Compare that to the industry average, which is closer to 56%.
So that higher equity weighting obviously helps their revenue margin.
Exactly. Higher fees on equity products. And this focus seems to resonate with their customers. They remain the top choice for individual investors, holding about 13.1% market share of individual monthly average AUM. They now serve 14.5 million unique investors. Think about that. It means roughly 1 out of every 4 unique mutual fund investors in India is an HDFC AMC customer.
Incredible reach. Just phenomenal penetration. Okay, let's get to the bottom line then. The financials. How did those look year on year?
Pretty solid growth. Revenue from operations came in at Rs 10,260 million. That's up 16% compared to the same quarter last year. Operating profit grew 13% year on year, reaching Rs 7,796 million. And the profit after tax, or PAT, showed a strong jump, up 24% year on year to Rs 7,179 million.
Okay, those headline numbers look good. 60% revenue growth, 13% operating profit, but then a 24% jump in PAT. That always makes me look closer. A PAT jump significantly bigger than revenue growth usually means there's something else going on, doesn't it? Yeah.
You're right to flag that. You absolutely need to read the fine print on the P8 figure. That impressive 24% growth does include a one-off item, a non-operational boost. Specifically, there was a reversal of income tax provisions from earlier years amounting to Rs 468 million. This came after a reassessment, so it's not recurring income from the core business.
Right, so if we pull that one-time tax benefit out to get a cleaner look at their actual operational profitability for the quarter.
Exactly. The adjusted P8 would be closer to Rs 6,711 million.
Which is still healthy growth, absolutely. But it gives a much clearer picture of the underlying performance rather than being skewed by that tax reversal.
Precisely. It helps set more realistic expectations about core profit expansion going forward. It wasn't all operational magic.
Understood. And meanwhile, on the shareholder front, a pretty strong signal of confidence from the board.
Yes, they approved a 1.1 bonus share issue. That's quite a significant move, generally seen as reflecting optimism about future earnings and wanting to increase liquidity. It's subject to shareholder approval, of course, with a record date set for November 26, 2025.
Okay, now, for what I think is maybe the most fascinating part of their story this quarter, it's this tension, isn't it, between HDFC AMC's longstanding reputation for being incredibly efficient, almost ruthlessly so, and this new push for what they're calling audacious growth. We saw total expenses grew 24% year on year. For a company known as one of the most cost-efficient asset managers globally, a 24% jump in costs. Well, it makes you ask questions. Is this a change in philosophy? Or just a very big bet? How do they justify spending at that pace?
Yeah, that's the key question, and they tackled it head on. They frame it not as losing discipline, but as necessary, calculated investment. Investment designed to fuel future growth while protecting their overall margin structure. Their core measure of efficiency, the operating margin, actually remains very strong. It's at 35 basis points of AUM.
And just to clarify for listeners, a basis point is 0.01%. So 35 basis points is 0.35% of their total assets under management is spent on operations. Is that right?
That's right. And their internal target is to keep that operating margin within a tight range, between 33 and 35 basis points. They also point to their cost to AUM ratio, which is incredibly low, just 11 basis points. If you adjust for ESOP costs, it's even lower, maybe 10 BPs.
So their argument is we're already so lean that to capture the huge growth opportunity ahead, we have to invest significantly, even if it means the absolute expense number goes up.
Exactly. They argue they need to spend to grow market share and absolute profitability. They're actually targeting about 12–15% annual growth in operating expenses going forward, seeing that as sustainable for scaling up.
Okay, so where did that sharp sequential jump in expenses this quarter actually come from? What were the main drivers? Was it hiring, tech spending?
It seems it was mainly front-loaded spending, tied directly to gathering assets. They highlighted 2 main things. First, significant spending on business promotion. This included launching 2 very successful new fund offers, or NFOs.
NFOs always cost money to market properly.
They do. They launched an innovation fund and a diversified equity fund, which together brought in about Rs 35 billion. That takes serious marketing spend. The second main driver was a higher mandatory spend on corporate social responsibility, or CSR, so a mix of growth investment and compliance costs.
Got it. Let's talk about that growth investment more broadly. Their long-term vision sounds incredibly ambitious. They used phrases like, to be the wealth creator for every Indian, and even to be the most respected asset manager in the world. Big words. Where are they actually deploying capital to try and achieve that?
Well, a huge focus is geographic expansion, specifically into what the industry calls B30.
B30 meaning towns and cities beyond the top 30 largest ones, going deeper into smaller town India.
Exactly. That's where a lot of the structural growth in new investors and SIPs is coming from, and they're putting their money where their mouth is. Over just the last 2 years, HDFC AMC has opened 50 new physical offices. And they explicitly stated that many of these are in B30 locations. They're making a real brick-and-mortar commitment, recognizing that B30 already accounts for nearly 20%, 19.7% to be exact, of their monthly average AUM. So it's already significant, and the potential is huge.
So a physical push into new geographies. But that's surely complemented by their digital strategy. That must be a huge part of the efficiency and growth story, too.
Oh, absolutely essential. The efficiency numbers speak for themselves. 96% of all their transactions are now electronic. 96%. But the interesting part is how they're approaching digital distribution. It's not just their own app or portal. They highlighted that their direct channel growth comes from a mix, their own platforms, yes, but also registered investment advisors, RIAs, and crucially, the major fintech platforms.
So they're embracing the fintech ecosystem, not trying to fight it.
Completely. They see fintechs as a vital channel. They even shared a stat that fintech platforms registered 15 million new SIPs, just SIPs, in this financial year alone across the industry. They know they need to partner with these players to reach that wider audience.
Okay, physical expansion, digital partnerships. What about new product lines? We have to talk about their push into alternatives. This feels like a significant strategic move away from just the traditional mutual fund business.
It absolutely is, and it's clearly a major investment priority for the future. Alternatives cover things like private equity, private credit, portfolio management services, PMS, and alternative investment funds, AIFs.
So more complex, often less liquid products aimed at high net worth individuals or institutions, stuff that typically carries much higher fees.
Precisely. It's a different market segment, often with much better margins if you can build the capability and distribution. And they're clearly investing heavily in building that capability. They mentioned hiring dedicated teams, 6 investment professionals focused just on the venture capital private equity side, and another 6 focused on the private credit side. That's serious talent acquisition.
So building the internal expertise needed to manage these specialized funds, have they actually launched anything concrete yet? Any traction?
Yes, they have. They successfully closed their first Category 2 AIF. It was structured as a fund of funds raising 1,200 crores. That's a solid start. And they're currently in the market fundraising for a performing credit fund. So the product pipeline is active. They are also looking internationally, setting up a subsidiary in Gifty City, India's international financial hub, and partnering with UBS Asset Management to attract global capital for India-focused investments, likely leveraging these new alternative platforms.
Okay, so pulling all these threads together, what's the big picture takeaway for you, the listener? It really looks like HDFC AMC is performing this incredible balancing act. On one hand, they're holding on to their reputation for world-class efficiency, keeping operating costs incredibly lean relative to their massive AUM. But on the other hand, they're simultaneously placing these really big, aggressive bets on future growth, betting heavily on physically reaching deeper into India via B30 towns, and betting big on building out this whole new, potentially very profitable alternatives business, investing today's profits to capture tomorrow's growth.
That's exactly it. The core story here isn't just about the Q2 numbers themselves, it's about that strategic tension and the balance they're trying to strike. How do you stay super efficient? That 11 basis points cost to AUM is just phenomenal, while also being strategically aggressive and investing heavily for the future. They believe they can do both. Use the profits generated by their efficient core business today to fund the investments needed to dominate the market tomorrow. It's quite a compelling strategy for scaling up in a market like India that's changing so fast.
That strategic foresight, that ability to manage both efficiency and investment, is often what separates the long-term winners. And maybe here's a final thought for you to consider on your own. We talked a lot about the sustained growth in SIPs, the millions of new investors coming in, even when the market benchmark was down for a year. It really does suggest that the Indian retail investor profile is changing, maturing from maybe short-term speculation towards true, long-term, systematic saving and investing.
So if this behavioral maturity is real and it continues, what kind of unprecedented new challenges perhaps around market liquidity or valuations, but also what new opportunities will the sustained structural flood of retail capital create for the entire Indian asset management industry and indeed the broader market over the next 5 years? Something to think about. That fundamental shift could reshape everything.